Good afternoon. Welcome to our webinar today, folks. We're going to give it another minute or so and let people cycle in as we have many participants coming in now. We want to thank you for joining us today, and we'll get rolling in just a couple of minutes. Appreciate you all being here to join us with our partners from Invesco and us with Bay State Financial. Give it another minute or so, and we'll get going. All righty, why don't we kick it off? And good afternoon, folks, and welcome to our webinar entitled People Care About Elections, Markets Don't. I'm Mark McManus, Head of Individual Retirement Income Planning here at Bay State Financial. And on behalf of our firm, Invesco Investment Management, and the advisor that invited you, I want to thank you for joining us this afternoon. The presentation will run about 45 minutes, and you're going to hear some fascinating information from our guest speaker, Brian Levitt. If you do have questions along the way, please type them into the chat function at the bottom of Zoom, and we will address those as time permits. If by chance we don't get to your question, please make an effort to reach out to your advisor and ask them the question, and we will get you an answer. So with that, I want to introduce our guest speaker today, Brian Levitt. Brian is Global Market Strategist at Invesco. In his role, Brian specializes in developing investment outlooks and analyzing timely market and economic data. Economic themes to determine what may have impact on investment strategies for both financial professionals and investors. He is the author of Invesco's Compelling Wealth Management Conversations program, which seeks to help investors manage emotions and stick to their investment plans. It's really focusing more on what your brain thinks about your investments than your heart. He also leads the firm's financial literacy program, which is designed to educate families on personal finance. Mr. Levitt co-hosts Invesco's Greater Possibilities podcast and is the author of Invesco's Above the Noise monthly newsletter. Brian joined Invesco after many years at Oppenheimer Funds when the two firms were merged in 2019. He started Oppenheimer in 2000 as a fixed income product management expert and has transitioned into his role where he basically is global market strategist for Invesco. He's frequently quoted in financial services media, including Barron's, Financial Times, The Wall Street Journal, and he is a recurring guest on CNBC, Bloomberg, and Yahoo Finance. He earned his MBA in economics from the University of Michigan and his MBA with honors in finance and international business from Fordham University. Folks, thank you so much for joining us today, and please help me welcome our very talented and incredibly knowledgeable guest speaker, Brian Levitt. Brian, take it away, pal.
Yeah, thanks, Mark. That is too kind of you. I appreciate the nice introduction. So, yeah, I'm gonna present this idea: people care about elections, markets don't. This was something that I have been saying all year, really trying to help calm people's concerns as we were going to the polls. Still strongly believe it. I will show you why I believe that over time, and also provide just a little bit of insight around what we just saw in the November election and if there's any implications as a result of it. So let's dig into this. Clearly, this was a change election, a red wave. We heard from the country that the status quo was not the right one. And clearly, when you get that, there's people identifying a lot of problems that exist. And so out of curiosity, and I go to things like Gallup and you ask, or you look at the polls, what are people worried about? You get economic and non-economic answers. I listed those on the left there. The economic ones, interestingly enough, the economy in general, although this is quite a strong economy, so a little bit ironic. I think what people really meant there was the second one, which is the high cost of living. So even though the economy's been strong, people don't feel as fortunate as they may have otherwise. Things like the debt and deficit still worry people, and I'll put some context into that. Reality is these aren't new problems. You know, this idea that we've never faced problems like this. If I look at the things that the founding fathers were worried about, very similar. For example, thinking about inflation and central banking, Thomas Jefferson called the central bank one of the most deadly hostilities existing. James Madison believed the public debt was a curse. Ben Franklin railing against inflation as a tax. So nothing new there. The non-economic side, things like immigration, poor leadership, right? That I guess that did in the Biden-Harris folks, unifying the country. If you look at the quotes on the right, again, not new problems. Alexander Hamilton talked about immigration dividing the community. John Adams said democracy never lasts long, it soon murders itself. And none other than George Washington said the distemper in our nation is incurable. So I think some of those quotes you could see in a newspaper today, and you wouldn't think that they were misplaced. So the problems aren't new, but clearly America voted for change. Now, anytime you have change or anytime there's an election, people get concerned that the incoming president might not be good for the economy or might not be good for the financial markets. Yet there's nothing in our data that would suggest that should be a concern of ours. So the way to read this chart, it's a scatter plot chart. You've got economic growth at the bottom across the presidential terms on the x-axis. You've got stock market performance top to bottom on the y-axis, and each president is plotted. So let's start it with GDP growth, that x-axis down at the bottom. Notice that legend or that scale starts at 1.5%, not zero, not negative. So all you need to know is each one of these administrations or each one of these presidents experienced economic growth. Okay. Now, if you look at the financial market performance, you'll notice I've got a dark line at 0 to pretty clearly show which presidents posted positive returns or experienced positive returns and which didn't. And so this goes back to 1957 when the S&P 500 went live. There's been 13 presidents and 11 of them have experienced positive returns. Not only have they experienced positive returns, you'll notice I dashed the line at 10. They're almost all above 10. Now, why 10? Because if you're getting 10% per year, you're doubling your money faster than the 8 years. The only two negative observations are down there at the bottom with W. Bush and Nixon. They had bad timing. They left office in severe recessions. So other than that, the markets have done just fine. Even the range of returns have done just fine, have been fairly similar across administrations. The way to read this is if you look at every president's picture and you go up, you'll see a series of dots. Every dot is a 1-year S&P 500 return on any day of the administration, just to give you a sense of the range. And what you'll find is they almost all get to enjoy a 35, 40% 1-year gain at some point. They almost all have to deal with a 20% decline at some point. In fact, if you look at the last two, Trump and Biden, what I would note, if you're worried about switching back and forth between the two, what I would note is the range of returns are very similar. They both got to experience nice upside, and they both had to deal with 20% downside. And interestingly, or coincidentally, that 20% down happened for both of them in the second year. In Trump 2018, Biden 2022. Now, what's not a coincidence is when you get downturns in markets, they're almost always the result of policy uncertainty. Okay, downturns in markets don't just come out of nowhere. So let's think about what those downsides were. In 2018 for Trump, it was A, the US Federal Reserve was raising interest rates, and B, there was a prolonged and unclear trade war between the US and China. So something to contemplate right now. we're not going in an environment where the Fed's going to be raising interest rates. That's good news. But I know there's a lot of excitement around the potential for stronger growth under Trump. Policy clarity will matter, particularly with regards to trade and industrial policy. Biden, again, also had a negative 20% in his second year, also because the Federal Reserve was raising interest rates. We had high inflation and policy uncertainty. So, I would look at it through the lens of, Trump's victory. Does it potentially bring forward some policy uncertainty? It may. I still think we're in a structural bull market. But to the extent people ask me about tariffs or a trade war, to the extent that there's a period of time where we don't fully understand the rules of the game, you may see some uncertainty in the market. But again, quite frankly, almost every one of these presidents had to deal with a 15 to 20% decline at some point. For people who don't like the outcome of this election, I'll show them this chart. People will often say to me, people said to me going into the year, maybe I should sit the year out. Well, how would that have gone? Or maybe I should sit September, October out, see if my preferred candidate wins. Well, how would that have gone? You're always better off with time in the market. And so, people now may say to me, Democrats now might say to me, I really don't support Trump. Maybe I should take my money out of the market. Right? Just the same way Republicans said that to me about Biden in 2020. So take a look. I wanted to show a growth of 10,000 in the market over a very long period of time if you had stayed fully invested. Fortunately, you can get a Dow Jones Industrial Average Price Index back to 1896. It doesn't include dividends, but you get what you get and you don't get upset. So if you fully invested from 1896, held it for 130 whatever years, today in that gray line, it's worth over $10 million. And again, that does not include dividends. So it would be substantially higher than that. The two blue lines at the bottom are if you only invested over that period when the Democrats or the Republicans were in office. And so you only climb to a few $100,000 versus 10 million. I think everybody gets what happens if you miss the best 5 or 10 days in the market. Everyone's seen that chart. What if you miss 4 years? What if you miss 8 years? What if you were a Democrat during the Reagan 80s? What if you were a Republican during the Clinton 90s, right? You would have missed out on substantial returns. So this is not a good approach. I'm not sure if anyone actually does this, but people ask me the questions all the time that suggest they consider pulling money out of the market if their preferred candidate doesn't win. Now, in terms of, that similar point, in terms of it always being the most important election and, this president's going to hurt the market, this president's going to be better for the market, all the stuff that we hear, the reality is it tends to not matter all that much for markets. And the way I wanted to prove this was a chart I created a long time ago, and I'm just stunned at how well it played out. I never had to delete it from my deck. The way to read it is it's S&P 500 returns from the day Trump was elected in November 2016 through his term or through the next election, from the day Biden was elected in November 2020 through the next election. And it's just remarkable how similar the lines are and how they end up in a very similar spot. And what I mean by similar, they both had good year ones. They both came down in year two because the Fed was raising rates. And of course, we talked about the trade war. Once you got better policy clarity, they both did well in year three. And what I mean by policy clarity, in both instances, the Fed stopped raising rates. They both did well in year three. COVID disrupted the beginning of year four for Trump, but you got right back on that trajectory. In fact, 957 days after they were both elected, their stock market performance was exactly the same. And they ended up fairly close with Biden at around 70%, Trump close to 60%. So it just doesn't matter as much as people think that it will. Now, this is an interesting one, and I want to spend a little bit of time on this. Before I read the chart to you or explain what we're looking at, I want to give a sense of what I think a lot of investors believe when Trump won in 2016 and then in the days after he won this time. I think what a lot of people see in Trump and a lot of people vote for in Trump is the opportunity for better growth. Okay. What if we cut taxes? What if we deregulate industry? What if we make government more efficient? Can we create an environment where the US economy moves to a new, higher, sustained level of growth? And if you do move to a new, higher, sustained level of growth, then it should mean interest rates move higher, very economically sensitive parts of the market, which we call cyclical sectors, outperform, smaller capitalization, domestically focused businesses should do well, right? So that is the so-called Trump trade. We got it for a while, 2016, 17. We had it for a few days this time. We'll see if it comes back. But the reality is there's more at work as an investor that you need to think through beyond just what the potential policy platforms of an administration may be, or what we perceive to be what they want to get done. Because, of course, they don't get everything done that they want to get done. That's not how the system operates. So one way to point this out is to just look at performance of different components of the energy sector, excuse me, under each of the last two terms. Let's start on the left. That's Trump's 4 years. Right? When Trump won, if there was an expectation of stronger growth, more drilling, I think almost everyone assumed traditional energy would outperform. And yet clean energy outperformed. How could that be? Well, one, we didn't go to a new higher level of growth. Growth remained fairly modest in the post-financial crisis environment. And then the pandemic hit. And when the pandemic hit, you lowered interest rates to zero. Now, who benefits from low interest rates? Clean energy businesses, because they tend to borrow. Traditional energy or cash flow generative businesses. Okay, so clean energy beat traditional by a lot. It's why I always come back to what's the direction of the economy, what's the Fed going to do? Right now, I would say the direction of the economy is generally stable, but pointing to, somewhat below trend growth. Okay, so to me, and the Fed's going to lower rates. That's what I would use to inform my views on the different parts of the market, not what I think the Trump administration wants to potentially accomplish or which sectors they favor. Now, on the right, you see the opposite of this. When Biden won, I presume everybody thought clean energy would outperform, and yet traditional energy outperformed by a lot. How could that be? Well, we went into a very strong nominal growth environment, nominal being real economy plus inflation. You all know what happened to inflation. So a very strong nominal growth environment favored traditional energy businesses. What happens when you have inflation? The Fed raises rates. Well, who borrows money? The clean energy businesses. And so they underperform. Okay, so there's other things at play. I don't like to get too caught up in trying to make obvious, quote unquote, obvious sector or industry calls based on who won, simply because they're often wrong. And a way to think about it is we assign so much hope to administrations, but they don't get to radically re-engineer the economy. They basically get to attempt to accomplish a few things, even under single party rule. One way to consider it is look at the chart on the left. Those are the components of the US economy, C plus I plus G, consumption plus investment plus government expenditures. The top dark blue is us, we're the consumer. We're about 60-something% of the economy. That middle blue area, which is the lightest blue color, is business investment. That's private sector stuff. You add those together, 80-something% of the economy is private sector. The bottom's government. So government, yeah, 20% of the economy, but private sector is going to drive this economy. But also note how remarkably stable it has been. Data goes back to the 1950s, so that's where I charted to. It has been remarkably stable. We don't radically re-engineer the US economy. The chart on the right, it was just a study done by Pew Research. What they gave is the line that shows the percent of substantive bills by congressional term. We could debate what substantive means. That wasn't really the point of me showing it. Reason I wanted to show it was to highlight periods of presidents having single party rule and to just show that that line doesn't go up in single party rule. You still need to decide what your mandate is and what you can get through Congress. And this is still going to be a slim majority for the Republicans in Congress. So again, I'm not expecting a radical re-engineering of the US economy by any stretch of the imagination. People do worry about debt and deficits. The expectation is Trump administration, if you cut taxes, could lead to additional deficits. There is talk, though, about on the spending side with the Department of, what are we calling it, Government Efficiency, the DOGE committee under Vivek and Elon, some spending consolidation. We'll see what it all looks like. But I wanted to just give you all a little sense of how to think through the debt and deficit story. This is a picture of your spending, which is in black, the black line, and your tax receipts, which is the light blue line. And of course, the difference between the two is either a deficit or surplus. In most instances, or almost every instance on this chart, it's a deficit. And you can see we run it whether I shaded it in red with a Republican in the White House or blue with a Democrat in the White House, pretty much running deficits most of the time. So neither party can really claim fiscal responsibility. Notice the two big periods of deficit spending we ran from 08 through 24. And that was really the government having to respond to two terrible crises in which tax receipts dried up and spending had to kick in. Now, as a country, it seems like people are pretty frustrated by what the government had to do over that period. I look at it differently. I sit here and say, if I told you 15 years ago, in the next 15 years, we're going to have the worst financial crisis and the worst pandemic in a century, I don't think many people would have thought the stock market would be near an all-time high and the unemployment rate would be near an all-time low. Okay, so our government helped us through this period. And in doing so, they ended up having to run pretty big deficits. Okay, so you take all of those deficits and you add them to the national debt, which is not pictured here, but I think most of you now realize national debt's around $36 trillion, which sounds like a very large number until you consider that the total household net worth in this country is about $160 trillion. Okay, so people worry about this stuff. But we're a very wealthy country. If you think about your own home, if you had net worth that was 6 or 7 times your debt level, I don't think you would be losing very much sleep over the debt level. Now, maybe you have a moment where Trump says we're going to lower taxes and the bond market says no go and interest rates go up a bit. The administration might have to back off of it. We saw that in the UK a few years ago, but that's not a crisis. That's just bond vigilantes returning for a brief moment. So no, the US isn't going broke. This is not, in my opinion, anywhere near the concern that people make it out to be. When you think of markets, you've probably heard the adage, don't fight the Fed. I've always argued that monetary policy matters more than a lot of this other stuff we talk about. What I'm showing here is our financial conditions index. That's the blue line there, excuse me. And then I showed you some periods of really good performance that presidents like to take credit for. They tend to happen when that line is going down. the financial conditions are easing, that the Federal Reserve is making things easier. That line goes up. Either the Fed's tightening or something's freezing, something's broken in the economy. Markets don't do well under those periods. So, you could be Clinton in the 90s, nice, easy environment on interest rates, great market performance. You could be Obama in the 2010s, post financial crisis, interest rates at zero, easy financial condition environment, markets do very well. Don't get me wrong, I would take credit for it too if I were the president, but that's just the reality of it. Even more recently, you can look at 2022, where that line had to go up. That's the Fed having to raise interest rates when inflation was so high. Not a great time for markets, 22. But then look what we've done since then. As the Federal Reserve had first been signaling lowering rates and then actually lowering rates, the market was up 65% under the last, call it 2 years under Biden, or close to 2 years under Biden. So that's what matters. And if you see where we are now, ask yourself, where is that line likely to go? I think almost everyone on this call would say the Federal Reserve is going to lower interest rates. So to me, that's a good starting point. That's a good backdrop for risk assets over the next 4 years, is that Donald Trump and his administration is going to experience an easing environment from the U.S. Federal Reserve. Again, don't fight the Fed. If you're upset about the outcome, let me just remind you, the markets don't care if you don't like who's president. These are the approval ratings up top for each of these presidents. I think the thing to note is used to have some prolonged periods of time where more than half the country liked the president. It was volatile, but you still had those periods. Really, since the second George W. Bush term, these presidents have generally been mired in that kind of 35 to 50 range that I highlighted. Obama was there 75% of the time, Trump was there 100% of the time, and Biden was there 85% of the time. And yet the markets did great under Biden, Trump, and Obama. In fact, if you look down below, it actually shows you that the market does best when the president's approval rating is between 35 and 50. So if any of you are upset or your community is upset, you can say, well, at least we know the market prefers it when a lot of us don't like who's president. 2 final points. Starting points matter to me as much as anything. It explains how perhaps modern standard bearers of their party, Ronald Reagan and Barack Obama, had very similar returns over their 8 years. How could that be if they don't have a lot in common politically? Great starting points. And quite frankly, Joe Biden had a very good starting point, and I was arguing that in the fall of 2020. What were those starting points? Terms began in recessions. Stocks were historically cheap. Fed was helping. In Reagan's instance, beating inflation. In Obama's instance, helping us recover from the global financial crisis. In Biden's instance, helping us recover from COVID. And they all benefited from good demographics. Reagan had the baby boomers. Obama still had the baby boomers and the millennials. For Biden, demographics were just fine. So what is it for Trump? Is the term going to begin in a recession? No. Okay, so not as ideal as these others. Are stocks historically cheap? No. The S&P 500 equal weight index is trading at about average, so neither cheap nor expensive. S&P 500 market cap trading above average. Is the Fed going to be helping? Yeah. Do we have good demographics in this country? Yeah. A lot of 30-year-olds, a lot of 60-year-olds who want to own stocks. So Trump's starting point is fine, not as good as Reagan's, Obama's, or Biden's, but I think the starting point is just fine. And then finally, for all this talk about the election and now the incoming administration, the most important thing, as investors is ingenuity, investment opportunities. They're ongoing despite who's president. As I showed you, 80% of this economy is private sector. And this is the most innovative country on planet Earth. And just think about it. I've been doing these presentations since 2008. So I just wanted to thank just give you a very abridged list of some of the things that have happened in the time that I've been giving these presentations. Cloud computing, 3D printing, ride shares, autonomous cars, virtual meeting software that allows us to do this, gene editing, virtual home assistants, smart homes, artificial intelligence, et cetera, et cetera. So I can't wait to see what the next 4, 8, 12, 16 years bring. And that's very much irrespective of the political backdrop in this country. So I'm going to pause there and turn it back over.
Thank you so much for sharing, Brian. Awesome information. I always love the data, like, because data, unfolds, it distances emotion from intellect, and you say, okay, let's let the data prevail. So can you speak a little bit to the idea of the red wave coming in to the political spectrum now, and what you feel may or may not be an impact by that? I know you hit on some of that, but can you expand a little bit?
Yeah, first point I'll make, red wave obviously means a unified government. I think every investor's been told the market's like divided government. There's nothing statistically significant about that. Actually, and the market's done just fine under unified Republican rule. In fact, the average going back to when the indices start is 12.9% under a red wave, and actually did just fine in 2017 under Trump. So that's no issue whatsoever. Yeah, I think when you get a red wave, people will assign to it, or a blue wave will assign to it what they want. And it goes back to the idea, Mark, of better nominal growth and whether you can sustain that, and to what to what level does a president control that? Right. You could think about Trump spending $4 trillion to get us out of COVID. Yeah, it produced a better nominal growth environment, including inflation, even though, the American public clearly pinned it on Kamala Harris. But it did create a better nominal growth environment. But did we sustain it? No. I mean, you put up a lot of money in people's pockets with a propensity to spend, but it doesn't come back again. So, this time it's more around tax cuts and deregulation. Tax cuts could work, but people that are going to be getting the tax cuts probably have a higher propensity to save the money rather than spend it. So it's a little bit of an overstatement to think you're going to get significantly higher nominal growth. Plus, you've got to deal with the trade concerns that people have right now. Tariffs at this point may look more like a tax on consumers than inflationary on goods. So it's a little bit of a Rorschach test. You remember those Rorschach tests, Mark? The ink blots. You see
Quite well.
Yeah, you see a sailboat, I see a butterfly. So some investors see better growth, some investors see uncertainty, and right now the market's really focusing more on the fact that the economy's stable but not accelerating.
Terrific. Appreciate that, Brian. We do have a few questions in the chat. Let me throw one at you right now. And the question is about projection for healthcare and tech stocks based on new leadership. But I don't know that you want to share projections, but just sort of thoughts on how those sectors might do with healthcare and tech stocks.
Yeah, I guess the health, I had said, like, I want to be cautious about making the quote unquote obvious sector or industry call, given things. I suppose the perception is that the healthcare stocks are a little bit in the crosshairs right now, and maybe some of the consumer staple businesses, because RFK Jr. was told to go wild on healthcare, and clearly there's a belief in his camp, and part of what I think Trump views as the mandate is that there's a lot of things going on that aren't particularly healthy for American people. Now we can all debate that, that'll extend to vaccines, or that'll extend to medical research, or it'll extend to the chips that we eat, right? So there's going to be an ongoing debate about that. I think the knee-jerk reaction is healthcare in the crosshairs. The thing I would caveat about that is, in a slower growth environment, healthcare is a defensive sector, typically tends to perform fairly well in that type of an environment. And given what's going on in AI and gene editing, and we may be on the
Hmm.
cusp of unbelievable advancements in healthcare. So I would caution about making broad generalizations as a result of that. Tech, these companies are so well positioned for the next year's intermediate period. I don't know if NVIDIA is going to be today or not. I don't really care, but these companies are so well positioned over the next years that I think you need to own them because they're really on the cutting edge and making big investments in what is likely to be a very nice structural wave generated by machine learning, generative AI, and everything involved in it.
Awesome. Great feedback. Thank you for the insight. Another question here in the chat. This is an interesting one. So from a redemption perspective, in October and November, did you see an uptick at Invesco in redemptions? You may not have this data, but just out of curiosity, did you see an uptick in redemptions in the October-November timeframe, or do people kind of stay in?
People mostly stayed in. This has actually been a good year for net sales at the asset managers. And, you know, some of that is just the FOMO of all of this. Yeah, I think people tell you they're going to peel out of these markets around the elections. I'm not sure actually doing.
Awesome. And then a question here, overall job market seems stable. White collar, mid to senior level jobs seem to be taking a little bit of a hit. Any thoughts on where that's going?
The job market's slowing a bit. I think what people have to realize is that 2 years ago we had 9.6% inflation, and we knew that we had overjuiced the economy. The two administrations put 6 trillion in. So we had to slow things down. Okay. And then when you do slow things down, you have inflation back at 2.5 and the market at all-time highs. You feel good about it, but for the fact that you slow things down. You know, it's sort of paradoxical that the market wanted you to slow things down. Why? You know, markets do fine if your money loses a few percent of value every year and you got to invest. Businesses don't like it if inflation's 10% a year because they can't plan. So you got to a sweet spot for markets, but remember, you slowed the economy down, right? That was the goal in all of it. And so when you slow the economy down, you're seeing it a little bit. The consumer's slowing a bit. You're seeing it at different ends. The luxury businesses are saying we're slowing a little bit. Walmart's saying we're crushing it because everybody's coming to us, right? So it's a little bit of a mixed bag. Remember, leading indicators of the economy are stable, but not pointing to lights out growth. So the job market starts to slow. You know, we had this period where we were told there was a great resignation and everybody rushed out to hire whoever they could. There was no great resignation. We have more people working today than we ever have before in US history. And, you know, we had a bunch of jobs open that are starting to go away. Business is really well. The consumer's not going to still be so lights out. I don't need that many more people. Or if I can automate some of it or use AI, and the quits rate is going down. You know what? You don't quit your job unless you think there's a lot of great opportunities out there.
Right.
So things are slowing, but you know, most Americans, that's what a 4% unemployment rate tells you. Most Americans who want a job have a job.
Fantastic. And I'm sure you knew this one was coming, but you know, with the election, there's been a little bit of excitement around crypto, if you haven't noticed. What do you think? Like the whole Bitcoin pushing 94, 95,000 or so. Where do you think that goes with this administration?
I don't know. I mean, there's been so many different rationales for crypto. So in the beginning, it was you can't own the dollar, you can't own the banks, you can't trust the banks, right? That was all post-global financial crisis. None of that happened. Dollar's very strong, and banks are well capitalized, you know, household net worths at an all-time high. So then it became we were going to use it in a blockchain. It's really the commodity that was going to drive 21st century economy. That didn't happen. We've heard about blockchains for 15 years. I don't think any of us are using it. So now it's really more of a beta play on the market, as far as I can tell. It's a speculative asset. The market goes up, this thing goes up more. And, the technical analysts, and I don't always just trust technical work, but when this thing was sitting at 65,000, technical analysts who I read every day said it was going to 125,000. Now, that's not me promising it. There's nothing about the charts that are magical, but that's what he said. He stands by it, and it's at $95,000 today. I still don't know what it's for. And I still have concerns about it because it is a claim on nothing. Now, that said, one thing to think about is, why has gold gone up so much? Gold has gone up a lot because we froze Russian assets. And if you are a country around the world that may someday have a tiff with the United States or the Western world, you better diversify your wealth fund. You better diversify your reserves. Does Bitcoin ever become that? I don't know. Is that what the market's thinking? I don't know. But I just caution that it's a claim on nothing. If you want to think about it from the perspective of total market capitalization, Bitcoin's now about 4%, 5% of the world's total market cap. So if you want to own it, that's a reasonable starting point.
Very insightful. Very insightful.
Thank you.
And last question before we wrap up. The proposed potential tariffs and some of the cabinet picks. Thoughts on what sort of change that may bring, if any?
With regards to the tariffs, I mean, that is, he ran on tariffs, right? Tariffs is his favorite word, right? Remember at the Bloomberg interview? So you're going to get tariffs. I mean, we got them from 2018. The whole year, every few months was a new tariff. First it was on washing machines, then it was broader, right? We did that for the year. But we should expect that. What way I tell investors, few things on tariffs. First is, your economic outcome is going to be less often. That's not a political statement. That's just a fact, right? If another country can do something cheaper than you, they should do it. If you don't want them to for political reasons or security reasons, you're going to have a worse economic outcome. That's fine. I don't think they're that inflationary. I think it's a tax. Currencies will adjust, so the dollar gets stronger. Other currencies get weaker, so they can still sell their goods into our country. And that hurts multinational U.S. businesses a little bit. Right. So again, you get a little bit worse of an economic outcome. My biggest concern about it would be a lack of clarity. Right. Businesses, you remember 2019, even Biden kept a lot of the tariffs in place. Markets roared. As long as you know the rules of the game, businesses, consumers will be okay. It's the uncertainty that would drive markets lower.
Love it, man. Well, Brian, I just want to say, I always love hearing from you. We've known each other going back to 2008 when you started doing this, and your information and knowledge is as good as anyone I've ever spoken to, and you're entertaining along the way too. So really appreciate all you bring to the dance for us today. Folks, hopefully you enjoyed what Brian had to share. If perhaps we did not get to your question today, please circle back with the advisor that invited you, and we'll be happy to address it on a one-on-one basis. Folks, I want to thank you for joining us today on behalf of Bay State Financial, our partners with Invesco Investment Management, and the advisor that invited you. Wish you all a happy and healthy Thanksgiving, and really appreciate you joining us this afternoon. Brian, thank you so much.
Thanks, Mark.